Hello, ladies and gentlemen. Welcome to stage two. Brilliant job. Stage one was very long, but ultimately was necessary. And I want to say just brief few words about the transition from stage one to stage two. It's important because obviously we're at that bridge now, and you've just come off, a huge stage, and probably for many of you, and this is a great thing, right? You've been like, whoa. Oh, now I see markets in a completely different way to anything I've been shown before. And actually, it's nothing special, right? It's not like I've given you some sort of envy's method. No, come on. At the end of the day, I hope you can all see. Every company in the world is just doing this. And what other way is there? At the end of the day, if everyone's buying a product at £10, that's fair value, right? What you're not going to go and say, no, it's £20. I mean, it's obvious, right? Transactions are driving the market. It is so fundamental and basic to any market auction or price in the real world. Forget about pound, dollar, and stocks and oil. Who cares? I'm not even talking about that. I'm talking about sellotape. I'm saying that because I've got sellotape in front of me. But in all seriousness, I am right. Sellotape, keyboard, mouse. Um, there's a cup in front of me. Salt, um, pens, whatever. Oh, you might be wondering why I've got salt on my desk. Is because I was eating on my desk earlier because I was in the midst of trading. So I don't normally do that. If the missus found out, she'll kill me. But anyway, there's salt on my desk, and the point is that the price of that fluctuates. Why? Because people are buying it at that price that it sells in the shops at, right? There's no other way of looking at it. So my only point is that I haven't given you anything that I've invented or something special, right? So I hope you can see now, whenever anyone ever says to you again, guys, I've got this amazing method and it tells you how to make money in the markets. You can see now, complete and utter cobblers, right? Which is, I don't know if you've heard of that term. It's slang. I believe it's British. I don't know, but yeah, it's cobblers. It's garbage. It's rubbish. Right? I mean, of course, it's garbage. At the end of the day, the only thing that's driving the market is the market, people buying and selling at certain prices, right? Anyway, the point of why I said all of this, and there is a reason, I always say that even though I waffle on for a long time, there's always a purpose behind it, is because I know that, and I saw this again and again and again, even in institutional circles. Basically, I talked about failure rates in, as I said before, in the reality check video, and even those in the professional circle, the failure rate was so high was because you see the things that I taught you in, say, stage one, like drawing composites. Tell you the majority of people would have come away with that saying, "Yep, I can do that." You know, I fancy a bit of that basically, and I like the way it gives me two lines to trade off. Brilliant. That's it. Every time it bounces, I'm going to do this. When it doesn't, I'm going to do that. No. Can you see why I'm even talking about this here? Because you've just come off the back of doing that. And I want to make sure that you haven't come out of stage one thinking, do you know what? I've cracked stage one. I can do the composites, guys. No, because it's such a small part of it. Honestly, it's not even 5% of stage one. It's really nothing. I'd rather someone is really struggling to do the composites and it's just like envy. I just don't get the composites. But actually, I get all of the other stuff. I get the auction market theory. I get the basic statistics. I understand why value areas in the normal distribution, they're not perfect. I get it. Because in the theoretical world, market orders would be uniformly distributed and sort of spread out either side of the VPOC or the mode or whatever you want to call it. However, I did notice that when I was looking at volume profile, market profile, it doesn't matter, either one, I noticed they weren't always perfect, NV. I did notice that the normal distribution model is perfect. But actually, when I was looking at profile, I saw profiles like this, where there was chunks missing out the middle. I saw profiles with 2 chunks missing or 3 chunks missing. So they were fairly balanced, but they weren't exact. And therefore I understand that this value area, or the fair value that I'm getting here, is not perfect, right? Because there's chunks missing, the market orders are not distributed evenly like you would get in a perfect normal distribution. I understand this is just a theoretical model of the world. The reality is these lines are just guides. Why do I say that? Because here I'm talking about individual profiles, right? What's a composite? Doesn't matter whether you've joined 2, 3, 20. It's a profile. It's just a profile. And at the end of the day, you're going to see that I use the levels on composites. Sorry, that's a terrible drawing. That is not what profiles can look like. But I use the levels on composites, right? So let's draw perfect. Let's say that is some perfect composites. And you merge all of these 3. You're going to get what? One big composite like that, right? Well, it doesn't work like that in real life, does it? You're going to have probably 3 like all of these shapes. And I'm not going to draw them out, but ultimately in real life, you've seen it, you get weird shaped composites. They're not, I mean, they're fairly accurate, but they're not perfect. And therefore, these composite levels that you've been drawing, I had you draw the boxes on, you've got to see them for what they are. That's all my point is. And that's why I talked about failure rates. Is, again, it's not because I'm some sort of pessimist and I want you to think there's no hope. No, the opposite. I want to give you the best chance of success, and I don't want you to fall into the trap that even the 90% in the professional firms that failed fell into. All right. Now, I hope none of you are sitting there thinking, nah, it can't be that high, like even the failure rate. No, you know what I would say is, look, just accept it. It's facts. You can see it. It'll be out there anyway, and embrace it. Deal with it. And think, how can I actually get into that real small cohort that actually make it? Well, this is really a big part of it. It's like, obviously, all the stuff I talked about in the reality check about trading live money, which I hope you're not, because I made it clear. If you are, well, probably not for you until you stop doing that. This is really now, I'm talking about the guys who, we're now eating our way through the 50, 60, 70%. You've now got to the guys, i.e. you're obviously part of that, potentially, if you've understood stage 1 properly. Where you're in that final sort of leg, not to consistency, but to potentially breaking through at least, the first hurdle of many. But in terms of the actual learning, obviously you are now in the final stages, and this is more of the advanced reasons why even the people who did all the stuff I say in the reality check still didn't quite make it, is because, like I said, they kept treating this stuff as an indicator. Because think about it, I could have just done stage 1, right? And just said, guys, market profile, merge them. There you go. Composites, levels, we're going to trade off them. Why didn't I just do that? I spent 90% of my time explaining auction market theory to you so you understand what these levels are. And the final word I want to say, and why it's so important, is that you understood it properly, is because you may have noticed the pace has really started picking up. Obviously, first you did depth of market, and I got you doing some exercises, and the pace was fairly slow. Then I've suddenly thrown you in, obviously, with the composite stuff, and you're looking at the depth of market, but on a chart. So obviously, there's a few more things to, because you're looking at multiple volume profiles, multiple depth of markets, and combinations, and obviously a bit of statistics. So I know the pace has picked up, guys. Imagine that pace. We're now going to times 5 that pace. So that's the reason I say all of this is, look, don't hesitate to go back to stage 1 if you haven't understood it in the way that I've just mentioned, because I'm going to ask you to go back anyway and watch the probability section again. Don't hesitate to spend more time and really pick it up, because what's going to happen is you're going to start treating all of this stuff that I show you now, especially the Vwap, because you'll see on the face of it, to those who don't understand it properly, they're going to think it's an indicator. Actually, it isn't. It's by far the most powerful observational statistic in the world when it comes to anything. It's the average, the weighted average. It's the most powerful descriptive statistic in the world. So you've got to see it for that and not see it as a line that you bounce off. So what I would suggest is, take your time. If you don't, hesitate to go back to section 1. And final thing I wanted to say is, and I know I already said it was the final thing, but this is really the final thing now that I wanted to say, was that, look, I understand that a lot of you have got jobs, you've got children, you've got commitments, and it's difficult to squeeze a lot of this stuff in. Embrace it. You don't realize you've got an advantage. There's no rush, okay? You're not going to get this overnight. I tell you, even at this stage, even when you finish this course, you're not going to be making money anytime soon. You're going to have to go through simulator, you're going to make mistakes, before you hit that road to consistency. It's going to be some time, let's be honest, and I've been honest about that. So use that to your advantage. In a professional firm, this is my point. The point is, in a professional firm, there's so much pressure to get this stuff quickly. They don't teach it to you in anywhere near the detail that I've taught it to you. Well, I know that because I went, to 2 of the top institutions in the world, as I keep saying, but I say it for a reason, because I want you to know that it's evidence-based, what I'm telling you. I wasn't taught any of the stuff in stage 1. I was just taught profile. This is standard deviation, as in they expected me to know what standard deviation was. They just said, there's the VPOC, there's the thing, whatever, and this is how we use it. So basically, I got about 10% of what I've shown you in stage 1. So my point is, take advantage of that. Take advantage of the fact that when I was in an institutional firm, there was a lot of pressure. I was expected to sit there 10, 12 hours a day, intensely cramming everything in, and then, you have to try and succeed very quickly. And point is, that's why the failure rate was also very high. If you've got this amazing opportunity to do it slowly with no pressure, and you might say, no, Envy, I got pressure, I need to basically be successful quickly. Well, then I would say to you, I'm sorry to say, this isn't the game for you. Don't put a time limit on it. Yeah, obviously I talk about the 9 to 12 month period, and that's a good time limit. But come on, probably what? We're into what? Some of you, obviously I asked you to spend 3 months on the depth of market. You should have spent at least a month on stage 1, right? Maybe a couple of weeks absorbing stuff, couple of weeks doing the composites. So really, this should be month 5 for you now. And I know, no offense to those that have actually done what I asked them to, 90% of you, you're not going to be on month 5 right now, right? You're probably going to be in your 2nd month, or your 3rd week, or your 4th week, or your 6th week, or you're not doing it correctly. I'm not having a go at you at all. I got no problem. And I know some people contacted me and say, is it all right for me to go ahead? And I've got no problem with it. We're all adults. You've got to learn at your own pace. My point is not that you've done it wrong by rushing ahead, even though in theory I didn't want you to. But the point is, that's fine. My point is that at least in your head, give yourself that 4 months that I wanted you to have up to this stage. Maybe start looking at the Vwap stuff. But if it starts, this is the point. If it starts because we are going to go at a very fast pace now. If you're like, whoa, I can see I'm falling into this trap of just using it as some sort of strategy when it bounces here, no. Utilize that 4 months that you've got. So my point is, I wanted you to do this. Ideally, say you're hitting this about month 5 now. You've spent 16 weeks. If you're already in this section after 3-4 weeks, do you see you've got a gap of 12 weeks? So my point is just use that. Keep it in reserve. Don't put the pressure on yourself to, if you get stuck at any stage in this Vwap section, or if you feel coming off the back of stage 1 that you're falling into this trap of just seeing it as lines and you haven't maybe quite got the statistics section or got the the auction market theory section. Go back. It's fine. You've got plenty of time. All right. And if you need more than 4 months, 5 months, who cares? This is my point. You've got to realize you're at a massive advantage to someone like me who was in a firm and I was under pressure to really get this very quickly and then to start performing and producing for my firm. Otherwise, I'm out the door, right? No, you've got a golden opportunity here. Take your time, pace yourself. It's a lot to take in, I know. A lot of you have probably been fed a lot of garbage for years, months, whatever. And hopefully you can see now that that is the case. Take advantage of that. So look, anyway, let's move on to the VWAP. Basically, I already went through this. I won't go through it again, but ultimately we've covered auction market theory, market profile, volume profile. As I said to you, I'm going to shift the VWAP here, which was what? Weekly, monthly, quarterly, yearly, are very much part of context. But so in terms of the actual institutional hierarchy, it is. But in terms of the learning, I'm going to move it here. Well, I already said, we've already done a huge amount already in section 1. So logistically, it makes sense. B, more importantly, I want to start you on the VWAP for the day. So essentially, it makes sense for me to, rather than keep going backwards and forwards, let's just draw a line under stage 1 from a pro course perspective, but not from a context perspective. All right, so hopefully you don't feel that, I said anything there that wasn't useful. Like I said, I know sometimes I go on, but it's because I really want you to succeed. And the only way you're going to do that is if I point out these little things that I saw in people, even in professional circles, the mistakes they made. I don't want you to make those mistakes. I really want you to have the best chance of success. And that takes time, you've got to give yourself the time to do it. Don't get frustrated. Do it in the right way. Don't rush ahead, etc., etc. All the things I've said. Let's crack on to the next slide. See how you get on with the VWAP stuff. Like I said, it's going to go at a pretty fast pace. And again, don't be shy or feel, that you've failed if you have to go back. In fact, you've succeeded if you accept. Maybe it's a bit fast, I'm going to go back. If you get it, great, crack on. I'm not saying that, but I'm just saying, obviously take it the way that you need to. Basically go at your own pace. You're not competing against anyone. So let's go to the next slide and then we'll start with looking at VWAP. Okay, traders, so we're going to crack on with the VWAP here. You can see I've put some bullet points on this slide. Really, before I get stuck in, and we're not long now away from actually combining VWAP with the composite levels to really start building some strategy, and I'll talk a little bit more about that, how we combine VWAP, which is just another form of value, with composite levels, which are a different form of value. We'll talk a little bit about that. But first, you need to know what the VWAP is. Why is it so important? You may have heard of it before, you may not have. It doesn't matter. I'm going to assume no one's heard of it, so it's important that I cover the theory. And as I hinted at for 15 minutes before I started this section, the same as in stage 1, I said, yeah, it's all well and good, you can do some composites, but the VWAP stuff as well, you're going to see it, you're like, yeah, I see the price is bouncing off the VWAP or the standard deviation band of the VWAP. No, this is much more important. They actually understand what it's telling you. Then, of course, you can develop an understanding of rhythm. And I talked about, I haven't talked about it, but I mentioned it in the bullet points of context, rhythm and acceptance. We can look at that. And VWAP really helps you to understand market rhythm. But, that's more when you get on the charts. Let's actually understand what this thing is. So VWAP is the volume weighted average price. And actually, I'm going to say it in the next slide, but if you didn't understand exactly what this was, we're going to look at it so briefly in the next slide because I already covered this in the stage 1 probability section. So I want you to go back to that, but more on that later. But essentially, it's the average price. It's the most powerful statistic in the world. And I'm not talking about moving average. That's all rubbish. I'm talking about the actual average that takes into account transactions that have taken place at every level. So we're going to discuss that rather than go into it here. it's just obvious, right? I mean, at the end of the day, you're using it all the time. You don't probably realize you're using it unless I point it out to you. You may do, and I apologize if you do, but obviously there'll be a lot of you that don't even realize you're using this descriptive statistic probably every day and you don't realize it. So, like I said, using it in everyday life. So clearly that's not necessarily in financial markets, is it? It's going to be in things like, let's say you're trying to find out the performance of how well, I don't have children, but if let's say I had a son or a daughter and they went to school, they might get a whole bunch of grades, right? Generally, do you not say to them, how did you do on average? Did you do well? Did you do not well? Do you see? That's an average. That's the volume weighted average price. Obviously, it's not weighted by volume, but it's weighted by grades at each level. You know, if they got 5 A's, 4 B's, and 1D, they're not going to, they might go into detail with you, but as a general description, if they were only allowed to use one word, they would say, I did well on average. Do you see? It's weighted by they didn't. It's not like, see, when you do moving averages, it's like, oh, I got A, B, D, whatever. I can't even remember exactly what I said, but if they got 5 A's and they got 4 B's, but they only got 1 D, you see, it's weighted towards the A's and B's, and they can then say, on average, I did well. Used in sports all the time. You know, if I don't know if you're a sports person, I'm not going to talk about a specific sport, but let's just say any sport, right? I talked about it with cricket in the probability section, but any sport where the scores are, let's say you have a period of 10 matches and the scores are 200, 200, 0, 200, 200, 200, 190, 200, 200, 200. If someone says, how did you do? You're going to be, well, on average, got about 200. You're going to say, oh, I got 200, 200, 0, 200, 200. Do you see? You're not going to say that. We talked about this a lot in the probability section, which is why I actually do want you to go back to it. But we said, didn't we? With obviously, if the government asked you to go and get heights of people in the sort of your country, you would come back and obviously you would give them an average number. You wouldn't sit there telling them every single person in the whole country, right? So it's the most powerful descriptive statistic in the world, bar none, okay? And the way that I've described it to you, it's exactly the same for financial markets. That's why every single institutional investor in the world knows what the Vwap is, okay? I've never met anyone who doesn't know what it is, at least know of it, using it. Every single algorithm in the world is aware of the Vwap, okay? You need to know this. It's just, it isn't an indicator, it's just, like I said, the average. It gives you a measure of performance in a way that's universally accepted, okay? So people talk about self-fulfilling Fibonacci. We all know that's garbage, right? I mean, end of the day, you don't, like I said, if you've got a child and they say, how did you do? They're not going to say, well, my grades bounced off the 50% Fibonacci, so I did all right. It's ludicrous. But they may say, on average, I did pretty well. Done okay. Scores, we just talked about in sport. They say, well, my grades, my scores where we talked about the 200, 200, bounced off the trend line between 0 and 200, so I did okay. No, of course not. So on average, about 200. Most universally accepted measure. So if there was ever a self-fulfilling number in the world, it's the average. And you see that, you know, I talk about it. I'm going to jump down and come back just because I'm mentioning it here. Like I said, every single algorithm in the world is aware of this property that we just talked about. And I haven't just made this up, right? You experience it every day. People always ask you, how did you do? And rather than have to explain, you know, every single 100 outcomes of whatever they're asking about, you, on average, I did all right, I did this. It's on average, right? So obviously everyone's aware of this. especially algorithms which make up, as I've said before, about 80-85% of the market. So in markets like ES, where it's mean reverting, guys, algorithm knows not only computationally is the market going to revert to the mean, but also because of this self-fulfilling nature that people know that typically towards the end of the day, the market likes to settle at its average fair value, right? Makes sense. We've talked about this a lot in auction market theory. You're trying to always seek fair value. If there's no other measure, well, you're going to go to the average. You're going to go to the average. Now, it's virtually identical, right, to volume profile. In fact, in many ways, it is volume profile because at the end of the day, I've already talked about this again, and I want you to go back to the probability section if this doesn't make sense. But what data is causing a market profile to build? Market orders. What are we using to calculate VWAP? Market orders. Okay. This will become clearer, but I have already talked about this statistics section, but it's exactly the same, okay? Basically, the VWAP, you can mark it on a volume profile. So yeah, it's basically just taking it off there and putting it as a line. It's basically an evolving volume profile. And which brings me on to my next point, is basically, and this is going to be a mouthful for many, don't worry, we're going to talk about this a lot in this section. That's why I needed the theory section. Because the VWAP, for example, may just be a line with the bands, the standard deviation bands. And that could be the VWAP. And, at the end of the day, it's very dangerous that you just see that as some sort of line indicator. It's not. It's basically what it is I've found it really difficult. I was having a look online over the last couple of days to see if there's anything on the VWAP out there, honestly. I haven't seen anything decent on the VWAP. By all means, I always say don't take my word for it. Go on YouTube, type in VWAP, but you're not going to see it explained the way that I explain it to you. Basically, the VWAP, it is exactly what I've put there. That is all it is. It's the intra-period. So that period could be day, week, month, quarter, year. Whatever period you pick, is that period's dynamic evolution of the volume profile. Okay, that's going to be a mouthful. I'm going to show you that. It helps us identify basically as the profile is developing throughout the day, if there's any balance or imbalance shifts within there. So again, I'm going to come back to this. I just want to kind of put this seed in your mind before we move forward. And then also, obviously, if the profile, for example, let's say it starts off really thin, and you see this is why I had you on the depth of market, and it just builds throughout the day, right? So then you get a bit more volume. Can you see? That's later on in the day, and then it ends up like that. You can't really have 1, 2, 3, and however many profiles side by side. It's not practical, is it? So if the mean started off, say, here, and then it was here, and then it was here, do you see it's not really gone anywhere? So that's what that line is. That is the VWAP. It's just a line. And you see that line tells me, oh, my profile was balanced throughout the day. This will make sense as we go on, but essentially that's all it is. It's just telling me how the shape of my volume profile evolved throughout the day. Because you can imagine, practically, I can't have 1,000 iterations of how the volume profile looked throughout the day. It's impossible, right? I need a line that kind of describes how the shape has changed, and this gives me trading opportunities throughout the day. So again, I did say before, the pace is going to pick up, so hopefully you can get it. But again, that's why I say don't stress, just maybe work through the first few slides and see if it's kind of making sense to you. If not, maybe go back and do some of the prior sections before. So in terms of time period, which I just want to talk a little bit about, but we'll go much more in depth when we look at the weekly, monthly, quarterly, yearly, is that this is the other huge advantage, right, of the VWAP. Pretty much, I would say close to 100% of institutional investors, you get the odd ones who do like to look at 2-3 day VWAP, but I haven't really seen that. I've seen some retail guys using institutional tools try to do that, but generally in an institutional environment, it's quite standardized in terms of day, VWAP, week, month, quarterly. Because if you think about it, it's accounting and performance periods, right? Generally, no matter what type of investor you are, you're going to be looking at how did I perform yesterday, day? How did I perform last week, week? What was your performance like over the last month? What was it like over the quarter? What was it like over the year? Can you see? Massive advantage of using this, and that's why it's just, I cannot describe how incredibly powerful this thing is, because everyone, I talked about the self-fulfilling thing, and I hate that word because people talk about it in indicators and it's complete garbage. This, however, logically it makes sense that everyone's going to be looking at this because it's basically so well aligned to how investors measure performance, accounting periods, etc., etc. So you just have to be looking at this thing because it's what everyone is looking at, as opposed to moving averages and all these things, right? Where you have these arbitrary numbers attached, 21 period, 15 period, 7 period, or whatever it is. I've pretty much said it to death. Complete junk. What is that? It's just a random number plucked out of thin air. I can assure you no one cares about a 20 period. It's just random. It means nothing. Whereas a day, does your broker not send you a statement for how you performed yesterday? Or does your broker send you a statement saying, oh, here's an email, here's how you performed over the last 8 periods or 8 hours? Or do you see, it's just completely ludicrous, right? Whereas everyone in the world, even companies, corporates, or whatever, you don't need to take my word for it. Go out there and see how they're measuring management accounts, financial accounts, performance, internal boardroom meetings. It's all about how did we perform yesterday? How did we perform last week? How did we do last month versus this month? How are we doing this quarter to date? That's why this is absolutely crucial, because it's developing through the month. Okay, so it's month to day, and you'll see this. It's basically dynamic versus profile, which, as you've seen, it can be fair. In fact, it is static. So you saw when we're combining profiles, it's for the previous day, it's for the previous days, plural, or it's for the previous week. This is intra period. So if it's a weekly VWAP, it's telling us how the profile is developing in the week, so we can make comparisons. People always say, like I said, I don't know if you've ever worked in corporate world or whatever. If you have it, you have. If you haven't, it doesn't matter. But the point is, if you have, you'll notice they're always saying, oh, week to date, how we're doing, month to date, etc., etc. You want to see how you're performing to date. So this gives us that kind of dynamic measure rather than having to wait for the profile to close. Do you see? It gives us kind of this leading edge into what the shape of profile not only is likely to be, but obviously we can see that, but more how it's developed throughout the day and how the market is likely to react to that. So this will make a lot of sense as we go through. Right now, I'm just giving bullet points to kind of give you an idea of what to expect that's about to come as we move forward. I'm just going to briefly say this, it'll become obvious, but basically, because it's always evolving, you can't make composites because otherwise it would become too, it won't really mean anything. It's meaningless. You'll see that it's ever evolving, right? Every second a new market order comes in, the VWAP changes, obviously. Just like any average, when you get new data, average changes. So I'll show you that anyway, very briefly. We already talked about the mean reverting nature. Now this, absolutely crucial. I'll remind you of this towards the end of the section, but essentially the VWAP is used by institutions and clients heavily. This is a fact. I saw it a million times. I used it myself heavily when I was in an institution. And essentially, you'll see there's a lot of brokers out there that will offer you sort of guaranteed VWAP execution at a cost, obviously. Because at the end of the day, it's like I said, it's the benchmark. the world's most universally accepted benchmark. On average, um, where was the price today? All right, I want to buy the market today. So, as an investment bank, we may be receiving a lot of client calls saying, I want to execute at the VWAP. I want you to get me VWAP execution for the day. You've got to understand, guys, this thing is basically the bedrock of value or performance across the whole institutional world. And this just sort of adds more proof to it, is all I'm saying, is the fact that institutions are using this all the time. They're measured on it. If you're a client and you're trying to measure performance and you've given 5 different investment banks orders to fill, how do you compare them? Well, the easiest way to compare them is obviously to benchmark them against the VWAP over time to see if they're um, getting you execution better than. Now, obviously, depending on if you're buying or selling, they're going to want to fill your orders below the VWAP, um, to get you better execution. Obviously, if you're selling, they want to sell above the VWAP to get you better execution, and then it gives you some sort of measurement, not only to measure each bank by, but also to give you some sort of measure of also outright and absolute performance. Because at the end of the day, if the average price is say 18, I'm just making this up, and you're buying the market and they're filling you at 20. Do you see, if you didn't have a VWAP and they just said, well, we filled you on average throughout the day at 20, how do you actually know? What does that mean if someone's telling you 20? Oh, the market average price, VWAP, volume weighted average, was at 18. They got me a worse price. That's not good. Whereas if they got you at 16, do you see, it gives you a benchmark where you can compare not only obviously different institutions if you've given orders to, but also gives you some sort of absolute benchmark as well to compare all these orders against. So, um, that's why it's really important to look at it again, amongst all the other reasons. And then finally, guys, if you really needed more convincing, go and have a look on the CME website. They use the volume weighted average price for settlements and so on and so forth. Okay, so it really forms part of the microstructure of the market. This thing, I would go as far as saying that I don't know any successful traders that don't use the VWAP. Okay, or at least are acutely aware of where this thing is. Okay, so yeah, if you're not using it, then, or you don't understand it, then that's not a bad thing. That's why you're doing this course. You're doing a professional course so you can learn about these things. So my point is, if you don't know about it, let's get you really understanding it from a real deep perspective rather than just a line on your chart. Okay, so let's crack on and actually look at some of these bullet points in more detail. Okay, so on this slide, we're just very quickly, just for the sake of completion, going to talk about what exactly the VWAP is. But actually, the reality is I've covered this extensively in stage 1.4, measuring probability. So I'm not going to cover the same thing twice. It's just pointless, obviously. However, rather than put it back in here, I would please request, go and watch 1.4. Whether you got it the first time, didn't, it was probably 2-3 weeks ago now. You're just going to get this section like a million times better than if you just try and get straight into it. Because I'm going to essentially assume that you got everything in 1.4, and I'm going to move on basically at that sort of pace. So yeah, really important you go and watch 1.4, because as I just fly through all of this, I'm basically using the same example that I used in 1.4. If you haven't got 1.4, you're not going to get it now. So you need to go back to 1.4 essentially, and just rewatch it. And like I said, even if you got it then, it's going to refresh your memory as to exactly what the mean was and how we calculated it and so on and so forth for this example. And when I start talking about shifts in the mean, it's going to make sense to you straight away. If you start to get into what I'm about to talk about here, which is essentially that fair value can shift markedly, and I'll come on to that in a second. if you haven't understood 1.4 well, or it's not fresh in your memory, so basically everyone, this section is going to be very difficult. So again, final time I'll say apologies, I sound like a broken record, but I'm trying to do it for your own benefit. I would suggest 100% of people watching this, go and watch 1.4 and then come back to this if you don't mind. Then I can really ramp up the pace and make sure that your understanding is where it should be. So anyway, I'm going to assume now you've paused it, you've come back, we're now here, and basically I'm just going to give a quick summary. So essentially, VWAP is the volume weighted average price. I've called it the mean, but essentially it's the average price. So it's actually the true mean, okay? And I've said it here. Any other measure of the mean, right, average, is junk. It's complete junk. I'm going to show you, and I've showed you many times why that is, but I'm going to show you again. And I'm not talking about the mode, we talked about the most common value. And see, this is why I want you to watch 1.4 if you haven't, because I've talked about all of this, different measures of description, how we use descriptive statistics to describe data. Anything that isn't the things that I've discussed in that section, and in particular when it comes to averages, when we hear about all these simple moving averages, exponential moving averages, guys, they're complete junk, okay? Anything that doesn't take market orders into account is completely meaningless, okay? And I'm going to show you, as I always do, and I've shown you this many times before, but let's just remind ourselves why that is. So for example, and I'm completely making this up, I don't remember the previous examples I've given you, but it's so easy to show you this or to illustrate my point. Honestly, it's so easy. Let's say that we're talking about pound dollar, right? And I'm going to show you this in financial markets, but also in the real world. And let's say throughout the month, obviously this is an extreme example, we've traded at, say, 120, 140, and 160. Now at 160, right, we've had, I don't know, again, just making this up, 10,000 transactions. At 140, and obviously to prove my point, I'm going to go to an extreme, but this is exactly what you're doing when you're using moving averages, simple moving averages, trend lines. It's the same thing because you're giving every dot the same weight, okay? Any sort of indicator that doesn't take into account volume or market orders, pretty much useless in my opinion. Pretty much. There might be the odd, very raw data points like the high, low, open. They're not distorting the data, are they? The open is the open. The low is the low. The high is the high. The close is the close. Anytime you're using indicators to distort price, if you're not taking into account market transaction, you're in big trouble. You're not going to succeed. So I've said here 10,000 at 160. Now imagine one transaction took place at 140 and one transaction took place at 120. Whenever you use any of these averages or whatever it is, guys, what you're doing is you're basically saying, oh, the average price of pound dollar, say on a simple basis, is 140. Can you see how incredibly ridiculous that is? No, clearly the average price was more like 160, okay? That is the volume weighted. We're basically taking into account the number of occurrences at 160 was 10,000, virtually nothing. But do you see, when you're using moving averages like simple or indicators, you're typically given the same weight to this, to this. Do you see, even when you draw a trend line between here or whatever it is you're using, why are you giving the same weight to somewhere where you don't even know whether there's been more than like one or two trends or however many, very few, relatively speaking, to other areas, okay? So obviously in this instance, it's going to be the volume weighted average price would be 10,000 times 1.6 plus 1 times 1.4 plus 1 times 1.2. Okay, now imagine that's the depth of market with your, sorry, 1 and 1. That's the depth of market. Okay, you get the picture, but let me just prefer to be neat here. Don't worry, the price is on obviously normally on the other side, but this doesn't matter. It's still the same point. So these are your market orders. Doesn't matter if it's buy or sell or whatever. It's basically, would you agree? This is your volume profile. You had 10,000 market orders at 160, one at 140, and one at 120. And I talked about this in one of the, I believe it was the probability section, where I said you can sit and calculate your Vwap if you really wanted to. Early on in the days, obviously a bit more practical, because as the volume profile builds, you just do volume times price plus volume times price plus volume times price, and basically that gives you your volume weighted average price. Okay, that's all it is. It's no different to what we did in 1.4 where we were measuring the heights. What was I doing instead of this? See, this is why I wanted you to go back to 1.4, because I'm not going to cover this in any great detail here. We already talked about this. You've got 6 here, so you're doing 6 times 180 plus whatever that is, 3 times 181 plus 2 times 182 height, right? It's exactly the same as what you're doing here. There's no difference. When you're not weighting it by the occurrences, this is my point. Do you see how ridiculous it is? You're basically ignoring the fact that most people, their heights are 180. You're basically saying, nope, I'm assuming that all the data I collected, it was 1, 1, 1, 1. And even exponential, complete, in my opinion, you know, the math speaks for itself. It's complete garbage. Because at the end of the day, you can say, oh, the most recent, I'm going to give it the most sort of weighting. What does that mean? I mean, come on, it's ridiculous. End of the day, you got, let's go back to the pound dollar example. You got 140, 120, and let's say the market moved up, okay? So the price went from 120 to 140 to 160. This time, let's say 10,000 transactions took place here, and only one took place here, and one took place here. Exponential would give that the most weight, that the least weight, less weight, and that the least amount of weight. It's just ridiculous. You're giving 10,000 transactions the least amount of weighting. I hope you can see why my point is that any other measure of an average on your chart, completely and utterly meaningless, okay? It's just complete junk. This is the only measure that every institution is looking at, because any statistician in the world is going to take into account frequency, okay? That's all volume is. It's just frequency, number of occurrences, okay? And let me give you one more example, okay? Basically, you know, I talked about cricket, but it doesn't matter. Let's say you had a bunch of 100 scores in a sport, and it was 0, and then you scored 299 times in a row. So you had 200, 200, 200, 200, but constantly 99 times in a row. What is that? It's just a frequency distribution, right? Where you've got 0, and basically that would have a count of 1, and then you've got 200, and that would have a count of 99, right? So you can put your 99 here, but I'm just going to put it here for ease. 99, right? If someone says to you, oh, what was your average score over the 100 matches? It's like you saying, oh, I got 0 and I got 200. It's ridiculous. You didn't. You got 299 times and you got 0 once, okay? It's like having 99 market orders at 200 and 1 market order at 0, but you're saying, do you know what? I'm just going to take the average of 200 and 0. Complete nonsense. And just saying it's halfway or exponential, it's a little bit more towards It's just completely ridiculous. Just take the data in front of you, right? And this is why I always say to people, if you're not looking at a volume, you've got problems, right? And I said this before in the previous slide about institutions are looking at a volume weighted average price. This is why, because it's the only measure of the average that makes any sense. Forget about financial markets. I just showed you it's applicable at any sort of situation in the world. You're using it, you just don't realize it because you don't see it as a frequency distribution. You see all the numbers written down individually like this, but don't forget I've just rearranged those like that. Everything you look at, I even talked about, sorry, I know I'm going on and on, but it's true. Look, at the end of the day, I said, oh, if I had a son or a daughter and they said they got can't remember exactly what I said in the previous slide, but let's just say it was 5 A's, 4 B's and 1 D. What is that? It's a distribution, guys. It's exactly the same thing. Fine, I don't have data on this side, but imagine I did. Just distribution. It's exactly the same. You can apply it to anything in life. The number of knives you have in your kitchen drawer and each different type could draw a distribution. And the probability of someone who probably had the same type of, I'm stretching it a bit here, but it's true, right? The average kitchen, if you did a sample of people's knives and shapes, and I'm not too familiar, I'll be honest, I'm not the greatest cook, but you see my point. It can be applied to anything. If you did a survey of all the different types of knives, and one was this length, this length, this length, you'd find generally there was a frequency around a particular length. By the way, this is just a random. It just goes to show. I didn't even think of that example before I did this slide. Just in the top of my mind, right? It just goes to show how universally applicable this sort of average is. Now, not everything is obviously going to follow a normal distribution because not everything has this sort of central tendency, but we talked about this before. So look, anyway, my point is all of this, I've already said it all before, so obviously I don't want to say it again, but you know how it is. I like to be complete. So I thought, let me just mention why it's so important and exactly what it is. It's essentially just a weighted average. So we can calculate it as I showed you on the depth of market, but obviously the computer just calculates it for us. So I talked about in 1.4, the weighted average of all the heights is obviously 179.4 centimeters. It's the same where you've got your day, for example. The day VWAP is just basically every single price that the depth of market or the market has traded at, weighted by the volume profile, because that is the volume, right? So if you, for example, had this shape of volume profile on your dome, and then you've got all the prices streaming down here, all it's doing is just taking each price, just in the same way we're taking 180 and obviously multiplying it by 6, because 180 is up here to look, 6 times 1, 2, 3, 4, 5, 6. It's the same thing. Here it might be like 11,000, but do you see, you don't want to sit there going 11,000 times this price plus 10,000 times that price, each individual price, and then divided obviously by the total number of market orders in the day. I mean, obviously that's for you to do that by hand, it's going to take you ages. The computer just does it for you, but essentially that's all it's doing. It's just taking the weighted average. So yeah, very, very simple. And that we already went through in 1.4. Now, this is where the VWAP really comes in, because the problem is, if you think about it, this is just a mean at one point in time. Would you agree, right? So essentially, imagine you were collecting these heights of the 30-year-old males, I think it was, and imagine this didn't exist. Okay, in fact, let's just get rid of all of this. fact, let me just, sorry, like I said, I don't necessarily prepare any of this stuff. I like to do it off the cuff so you can really get a true understanding of it. Okay, what I wanted to do is I just want to cross them out individually, because what it is imagine you're collecting this survey, right? So half of this data doesn't even exist. So let's say that isn't even, and I'm going to show you this on a proper volume profile. As you're collecting the data, imagine you were calculating the mean every time new data came into the market. These are just market orders. So initially you had 185 and you had 177, right? So what's the average of that? Well, it's just the average between the two, isn't it? So what is that? 181. Okay. Then you get new data coming in, 180. It's going to shift the mean down, isn't it? Then you get 170. You can do this, by the way, yourself, obviously. Just pull out your calculator and just start noticing how the mean shifts. Then you get 180 come in. That is going to go down. 176 comes in. It's going to drag it down further. 176 comes in again. It's going to drag it down. 180 comes in. It's going to drag it up. Just you're going to have, the mean is going to be changing all the time. Guys, that is the VWAP, okay? The VWAP is a measure of how the market is changing at all periods of the day. See, and again, this is why it's so important you go back and watch 1.4, because I also talk about standard deviation. And I'm just going to assume you know what the standard deviation is. Obviously, I'm not going to cover that again. We covered it in great detail in that. But coming back to the mean, the problem is, right, okay, the mean will be building up over time. Problem in financial markets is the mean can tend to shift, right? We've seen this intraday. Obviously we see it, but even people, let's say you don't trade intraday, you see it all the time, don't you? Let's say pound dollar, for example, it shifts, doesn't it? It has these shifts over years, of like, it goes from like 150 to 160 to 170, and it can have these periods where the mean price is almost shifting. And the thing is, right, the problem in financial markets is, in the real world with traded goods and services, this average price we see, this weighted average price, we can apply it to bread, we can apply it to milk, we can apply it to cheese, we can apply it to anything we want. And actually what happens over time is the price will shift, but it's very slow. We talked about this sticky pricing, do you remember, in auction market theory? If you think about the price of bread in Tesco, Sainsbury's, whatever, let's say it's about £1. Do you agree? It won't necessarily change much for a few days or for a few months. The same thing as what I explained about pound dollar will have these shifts over years where it's noticeable to everyone because they go on holiday 1 year and then a couple of years later they all say, oh my God, the currency's changed. Problem in financial markets is, have you noticed, this is happening every day. Why is that? Because market orders, there's so many market orders coming through, and I talked about the price determination process is happening second by second. So the problem is this mean, it's shifting throughout the day so frequently that to actually capture this, I said here, the profile doesn't capture this intraday period change well. Guys, you literally need a picture, a snapshot of every single profile, every single minute new market orders are coming in to be able to compare them. Because think about it, in the same way that, heights are coming in, and it's not such a problem because generally everyone who's 30 or whatever the age bracket was, there tends to be this fixed central tendency. So the mean will, even over long periods of time, it will typically tend to be around here. It won't necessarily move. Whereas in financial markets, as new data is coming in, markets do tend to shift quite radically. Yeah, because you get fundamental news, you get this coming in, you get that coming in, and until they really start to settle, that mean can, even throughout the day, change quite rapidly, is my point. The process that you may see happening in everyday goods and services happening over a long period of time is happening in an